So, it's that time of year again, and everybody is talking about the upcoming stock market crash in 2021. But this time, they're actually right. I mean, come on guys, you're listening to IQ Investing. You really think I'm going to feed you with that bullshit? I'm going to tell you why you shouldn't listen to all of the noise about an upcoming stock market crash in 2021. Because I don't care where you hear it from, how qualified that person is, or what magical powers they have, nobody knows when the stock market is going to crash. But if you are still a bit worried, then we're going to go through some common investing strategies that people tend to use during market crashes or during bear markets. And then we'll figure out whether any of them are actually any good. Using that information, we'll take a step back and figure out what the best strategy actually is. So that when the next bear market does come, you can navigate your way through the storm without finding any brown stains on your underwear. With that, let's get straight into it. The stock market is going to crash. Unfortunately, I'm not even lying to you. But the thing is, when is it going to crash? Since 1928, there have been 26 different bear markets in the S&P 500, which all have an average length of around 9.6 months. Just so you know, a bear market is classed as any time in the market where we experience a fall of 20% or more. So that means, on average, we get a bear market every 3.6 years. Well, that seems like some pretty useful information. So what can we do with it? Well, absolutely nothing. And here's why. Let's say that you want to avoid the absolute worst of a bear market, otherwise known as timing the market. So your plan is to sell out of the market just before a market crash happens. Then, when it reaches the trough or the lowest point, you simply buy back in and maximize your returns. So to do this, you have to do two things. You first have to know exactly when the stock market is going to crash, and then secondly, you have to know when it's at the low point and when it's going to start rising again. Now, as you know, unless you've got some sort of crystal ball, then you're not going to have much luck. Unfortunately, bear markets aren't kind enough to just pop up every 3.6 years, and they certainly won't all last just 9.6 months. To give an example of what it would look like if you tried to invest with that in mind, let's rewind back to 2009.
Owners couldn't keep up with their payments.
Foreclosures are rising, and the biggest problem is that prices continue to drop. Until home prices stop falling, things just aren't going to get any better.
The world was in shock. Many people have just been through the most savage stock market crash in their lifetime, with a top to bottom drop of 54%. But let's say that you want to try and time the next stock market crash. So when the market was at its bottom in February 2009, you start investing. You wait 3.6 years, the average time between bear markets, and then you sell out in September of 2012. Now, before we carry on, let me remind you that this probably wasn't even a crazy thing to do. I wasn't investing in 2012, and as a matter of fact, I probably didn't even know what the stock market was. But I can almost guarantee that some people, whether it was a media or some sort of industry professional, were predicting a stock market crash. People had just been haunted by the market crash of a lifetime. Do you really think they were going to predict the bull market that was coming up? I don't think so. So anyway, you've sold out and you're waiting patiently for the crash. Well, I hate to tell you, but you're going to be waiting a long time. 8 years, in fact. Until the next bear market, which started in February of 2020. So the biggest stock market crash of our generation was followed by one of the longest and most lucrative bull markets. Who'd have guessed? But anyway, you just shake off your misfortune and you're determined to redeem yourself. So when the market starts to crash, you sell out. And then you wait 9.6 months to buy back in. From that point, if you'd waited 9.6 months, waiting for the bottom of the market, then you'd be buying back in December of 2020. Well, again, you'd be pretty screwed, because the bear market lasted only 33 days, and you'd have missed out on 26% of growth. So, what's my point? Guessing the beginning, middle, and end of bear markets is pointless. There's always going to be some sort of sign of a bear market, and who knows which one is going to be true. But, as I mentioned before, stock market crashes are inevitable. So let's talk about some of the strategies that get thrown around to try and navigate bear markets. The first of which is a big one, and I see it happening all the time. Leaving plenty of cash to one side so that you can buy in when the markets finally plummet. Now, don't get me wrong, we should all have some cash put to one side as an emergency fund just for a rainy day. But having more cash than we need can be damaging for our returns. If you leave cash uninvested, it's not going to be earning anything for you, especially with interest rates right now. In fact, you're probably going to lose money to inflation. So if you have your money put to one side waiting for a stock market crash that never comes, you're going to miss out big time. Let's go back to the example that we had before, where an investor tried to predict a crash in 2012. Let's say they left £10,000 to one side. From 2012 up to the next actual bear market, the markets grew by 100%. Yes, you heard me right, 100%. So that cash that was sat on the sidelines, gathering dust and being eaten away by inflation could have been doubled to £20,000. But it didn't. We really just want to emphasise that it is impossible to guess when a stock market crash is coming. I don't know if you remember, but even at the beginning of this year, there seemed to be thousands of signs that were pointing towards the fact that there'd be a stock market crash. People were certain that equities had recovered too quickly from the last bear market, and that there had to be some sort of correction. Well, fast forward 9 months, and we've had returns of 17% so far this year. The amount of people that I saw online in Facebook groups saying that they're going to put cash to one side so that they can invest when the stock market crashes is unbelievable. There will always be a reason for a stock market crash. People will just justify anything. Anyway, I'm getting sidetracked, so we'll move on to the next strategy, if you want to call it that, which is to panic. Of course, investors won't admit that they're panicking. They're obviously just changing their portfolios to a defensive position to avoid the worst of a bear market. I think they're panicking. Now, you probably don't need me to tell you that this is a bad idea. When you sell when your investments are down, all you're doing is locking in the losses that you can't get back. Nobody knows where the bottom of the bear market will be, and nobody knows which assets are going to be best throughout the storm. The returns from different asset classes throughout bear markets is random. If one asset type performed well through one crisis, it doesn't mean it will perform well in the next. This data from Fidelity shows how different asset classes performed through the bear market from 1999 to 2003. The two best performing asset types throughout this time were commodities and real estate. So it would be easy to think that when the next bear market comes along, you should move into commodities and real estate to try and get the best returns. Now, this data shows the return of the same asset classes during the bear market of 2007 to 2009. Would you look at that? The worst two performing asset classes during this period were also commodities and real estate. So again, trying to guess the winners is a fool's game. But there is still something that we can learn from this data. During both bear markets, the final years produced consistent returns across the board. As a matter of fact, 56% of the S&P 500's best performing days happened within a bear market. Another 32% of the market's best days took place in the first 2 months of a bull market. We cannot afford to miss out on the recovery from bear markets, as that's where you get the best returns. If you're just sitting on the sidelines waiting for the best time to jump back on the train, you're probably going to miss it. So, onto what is probably the most important part of the video. How do we make sure that we don't get scared when the markets do inevitably crash? Well, the first step is acceptance. You have to fully accept that a stock market crash is going to happen. Don't shy away from it. You have to realise that it's not going to be nice. In fact, it's going to be awful. Equities fall by an average of 36% during bear markets, but really it can be as high as 50%. So, to those of you that are invested in a 100% equity portfolio, here's a little exercise. Look at whatever number is in your investing accounts right now, whether it's £1,000 or £1 million, then half it. How would that actually make you feel? Would you be able to hack it, or are you going to end up with some brown stains in your pants? Don't take this exercise lightly. Really think about it. Imagine that your portfolio is 50% down. You're 2 years deep into a bear market, you don't know when it's going to end, and you don't know how much further the fall is going to be. Plus, just to add to that, your friends and your partner are shouting in your ears, telling you to sell before you lose everything. Trust me when I say this, it is going to be horrible. Maybe it could last 2 months, but maybe it could last years. And it's going to be very easy to make some irrational decisions when your portfolio has been down for so long. So let's say that situation does scare you, and fair enough if it does. The next step is to figure out what doesn't scare you, or at least what you think you can handle. Let's say that you can handle a drop half of that. Say 25% for example. Well, in that case, it makes sense to prepare your portfolio now so that you shouldn't experience more than a 25% drop when it comes around. We need to prepare for the worst case scenario, and doing it ahead of time is better than panicking and realizing that you're screwed when it's too late. Remember, stock market crashes are inevitable. They will happen. We just have to be prepared when they do. So, how can we prepare and limit our losses when equities crash? Well, bonds are a good starting point. Bonds, or fixed income, are about as stable as it gets when it comes to investing. They're separate to the equity markets, and the returns don't necessarily correlate with market crashes. In fact, in some cases, bonds actually perform well during bear markets because other investors panic and then they sell their equities and move into bonds, which increases their value. Also, stock market crashes often come hand in hand with economic depression, where you can see inflation rates fall. When interest rates are low, bond returns are high, so they work well as a hedge. Now, I know that many people won't like this answer, because bond returns have been historically low in recent years. But that doesn't mean that bonds are useless. bonds aren't in our portfolios to earn us returns. They're there to smooth out the ride and to limit our losses. So if a 25% fall is all you can handle, then add an appropriate amount of bonds to your portfolio so that when your equities crash and could lose 50%, it doesn't destroy you. An often used balance is the classic 60-40 portfolio. If a 60-40 portfolio, that is 60% equities and 40% bonds, goes through a stock market crash, then the equities get halved, so you lose 30%. Then the 40% bonds should actually perform well, and let's say they boost your returns a little. Call it 5%. Then you're at your target. You made it through a stock market crash and your overall losses were 25%. Now, of course, these are just some random numbers and it's not always going to play out like this, but you do get the picture. We also need to think about how we can stop ourselves from fiddling with our portfolios. That is, trying to move into different asset classes when the bear market comes. This all comes with diversification. A diversified portfolio will be less likely to feel the effects of a crash where it hits worse. You'll be spreading the risk and minimising the damage. Not all aspects of a diversified portfolio are going to perform well all the time, but they're also certainly not all going to perform badly either. Preparation is key. We need to make sure that we have these things in mind before a crash arrives, before it's too late. Trying to predict when a stock market crash will come is pointless. Trying to react to one is probably even worse. So take this time to reflect on your portfolio. It's not just about getting the best returns when times are good, it's also about surviving both mentally and financially when the bad times come. The more comfortable you are with your portfolio, the more comfortable you will be when the next stock market crash arrives. And the more comfortable you are, the more likely you are to make it through to the other side without making any irrational decisions that are going to hurt your returns. When the next stock market crash comes, I'll be praying for you. See you next time.